line maybe having technical difficulties. So we'll give them a couple minutes. That gives me a chance to get our shameless plug-in here on our latest book. But before I do that, just make sure you guys can hear me. Type yes in the chat section. That'd be great. Again, my name's Josh Asher. I'm the Director of Business Development here at TAM Portfolios. We do these webinars once a month, typically on the third Wednesday. And for some reason, when I sit down and have these conversations with Janet Yellen, she must not be figuring it out, because I asked her to move her meeting because it is in conflict with our webinar, and she just apparently isn't paying attention to me. I don't know quite who she thinks she is, but actually, in all seriousness, we are looking at maybe possibly moving these around based on some of the Fed announcements. So if anybody has any recommendations, we'd be open to hearing about it. And the purpose of these are really to give you guys kind of an idea of where we see the markets and kind of what's going on with the markets. We've got our chief strategist here with Tesseract, Kevin Tuttle, on the line. He's going to be really kind of going through and giving you our viewpoint. And we also actually just published our quarterly report, which you should be able to download from our website. Then, as always, we're going to get into some of our portfolios and how we think they can help you in the current market environment that we're in, conversations that we're having with advisors, things that they're doing to be able to use our strategies to add some advantage in their allocation. So we'll go ahead and get going. Again, before I do, I also wanted to just thank the folks over there at PAG, the Private Advisor Group. We recently kind of entered into an agreement with them. We were up there last week, so we're very excited to be on board with the Private Advisor Group, and we look forward to helping your guys as advisors, and if there's anything we can do, just let us know. So I'm going to go ahead. We'll kind of get things going here. If I can get my PowerPoint to change. There we go. Here's the agenda. And again, guys, just let me know that you can hear me okay. That would be great. Type a yes in the chat section for me. Also, that way I know you're paying attention. All right. Here's the agenda. We've got, again, Kevin Tuttle. He's the chief strategist. He's going to give a large behavioral, well, really fusion analysis overview of the markets. Talks about behavioral finance, fundamentals, and technicals. And then if he actually gets done talking in decent time, it is Kevin. So we're going to try to get you out of here at 30. We're going to shift it over to Rocket and myself. We're going to talk about some of these portfolios, and we're going to get things going. So Kevin, I guess in order to keep things kind of timely, I'm going to turn this over to you, and we will also be here to answer any questions anybody has. So here you go, Kevin.
Thanks, Josh. Again, it's a pleasure to be here today, and I guess you need to figure out Janet's new email. I think since she's moved to the Fed, she's probably switched it, so you have her old location.
Must be going into her spam box or something.
Yes, probably. Couple things. First of all, I'm going to jump right into it. Again, we're trying to get these down and narrow the presentations and the webinars on a quarterly basis, or I'm sorry, a monthly basis, but bring these down to a half an hour. So I've been yelled at quite a few times by taking up the majority of the space, so I will jump right into it. If anybody hasn't, you can go ahead, log into our website, and download the quarterly review. The quarterly review this quarter, if anybody has been following us through the Morning Cup of Joe, is called The Spring Winding Conundrum and the Science of the Market. And what it does is it dives into how we've seen a substantial increase in volatility in the marketplace, and that is an indication that the market may be getting tired. It is not a complete indication that the market is shifting stance and, let's say, going from a bull stance that we've been in for 5+ years and converting over into a bear stance. In actuality, we look at the world as bull neutral, bear, and bear neutral, whereas those apexes, the neutral zones, are the most volatile. And what I'm going to show today, just very, very briefly, is show really where we've come in the last year. And what you're looking at on the screen right now is the Nasdaq 100 index. Now, this is an index we follow. We don't typically follow the composite. We feel that this actually is a better way to look at the true moves of the Nasdaq marketplace. And without getting into debate, we'll just move on. But what you're seeing here is you're seeing a dark blue line underneath, which is your longer-term trend. And this trend has been in place for just over a year. And that prior to that, you saw that dip, which was back in November of not 13, but November of 2012. And the market's been somewhat on an expansive mode. About halfway through, you can see that it started a secondary trend, which is the blue dotted line. And that blue dotted line is where the market has been running over the last 6 to 8 months. And as you can see, as the market is transgressing forward, you're getting an increase in volatility. And that increase in volatility is a concern because you're getting more people waiting on one side than the other. I think the most important thing right now to realize is the market is in the process of shifting from a liquidity-driven market to a fundamentally driven market. Now, I know that you guys have heard us talk over the last 6 months, if not even a year, of when the Fed begins to taper and when they stop supporting the market. The question becomes, where is that market going to go? And it has to be based on something. And if it's going to be based on GDP, consumer sentiment, it's going to be based on retail sales, which, if anybody knows, retail sales came in at 3.8 on a year-over-year basis, which was a very, very good number. We were tilting with that very precarious 2 number on a 2% year-over-year growth. If you start dropping below that, you have a tendency to dip into a recession. So the number was very good. That gives an indication. Consumer confidence just came out in the low 80s, 82.6. And so these are good signs. People are still feeling happy about where they're at. However, the first quarter report, I'm sorry, this is the first quarter report, the end of the year report, we titled that velocity. And the last time we had a webinar, and over the last 2, we've talked about velocity, whereas the taper money, the $3.1 trillion, is pretty much 87% of sitting on balance sheets, whether it's corporate balance sheets of $500 billion or whether it's banking balance sheets of $2.7 trillion of that $3.1 trillion that's been pumped into the system. Well, actually, now it's $3.3 trillion. And if it doesn't start to work and go to work, which means businesses have to start investing other than just financial engineering, which is M&A, mergers and acquisitions, which you're seeing quite a bit of this year, then you really do have a little bit more of a problem because, again, if you're switching from a liquidity-driven market where the Fed is pumping money into the system, you are only going to be depending on a fundamentally driven market. So you're going to be watching, going forward, this volatility that you're seeing is created from the fact that the investors' eyes are now focused on every nuance of news that is going to come out. They want to know, are we going to be able to support the PEs that we are currently at, the valuations that are in the market? And as many of us know, the Nasdaq, as well as more so the small caps, are at valuation levels well within the 95% of their historic norms. So they're way, way up there, which is okay as long as you can have that driven behind it. Now, the first bubble that occurred, or well, I should say the first correction that has occurred, as everybody has seen, is the biotechs, and that has driven the Nasdaq. So there's been a lot of questions of whether the Nasdaq is going to be able to sustain where it's at. Are the cloud-based businesses such as the Amazon, which is at a 250-plus multiple, is it going to be able to sustain that kind of growth going forward? And these are the major players that you're seeing in the NDX 100. And in front of you, we've already talked about the 2 trends, the longer term, the dark blue, and the shorter term is the dotted blue going up. And one thing on a technical basis that I want to point out is you can actually watch volatility. And by watching volatility, you can pull the ATR, which is the average true range. And now in the blue shaded area above is a 14-day ATR. Essentially, without going too detailed on it, it is the difference in between the swings of the high and the low on a daily basis. That's not exactly it, but again, you get the point. And then this is an average of the 14-day. And you can see that all the way back in 2013, that it was right around 1%, which is pretty standard for the Nasdaq marketplace. And then you can also see now the average is 1.2%. Now that may not seem like a big deal, but when you extrapolate that you have a 20% increase in volatility in less than or just over a 1-year period of time, it's pretty substantial. But what you'll also notice, the blue line that is heading north, we're currently pushing 1.95, almost 2% on a daily basis in the intraday swings on average in the Nasdaq. So we are now getting to a point where this is starting to concern us. And it's concerning us because when you get that type of infighting, if you will, the tug of war in the marketplace, and now you layer that on top of the fact that you have the Fed making these decisions whether or not Janet Yellen's comment last time was a gaffe or not in regards of, increasing interest rates 6 months after taper starts, you're starting to get this pull. Now, on a technical basis, I'll drop down to the white chart below, which is the NDX again, and I've drawn out a potential situation. Now, needless to say, this may or may not happen, but when you extrapolate how long this could last, and people always ask themselves, how long could it last? How far could this drop? Where could it go? And how much volatility should I expect going forward? So what I'm here today is to give you a way that we believe that you can ascertain those 3 questions. So first of all, if you look at what we have, essentially it looks like a house, right, the top of a house. And as the market was going up, again, it was becoming more volatile. And then in March, you see the red line down the middle, 314. You'll see that that was the apex of this particular move in the marketplace. And if you extrapolate that going forward on a technical basis, as far as you bounce, the likelihood is you're going to bounce just as long and associate with time. So if that took 3.5 months to get to the center, we could anticipate, now again, not always being accurate, that it could last another 3.5 months of this kind of volatility before you have some sort of a resolution. And that resolution will have a lot to do with clarity both on the economics and also on the Fed. Now, I know Janet came out again and was speaking today, and I won't call it backtracking, but she's definitely trying to put the toothpaste back in the tube when she came out and said that she's going to raise interest rates 6 months after the taper end, which would be a year from today. Now, going forward, we expect that this volatility in the NDX, you can see the bottom line is 3,400 and the top line is 3,700, and you're getting that 8.5% or essentially 400-point swing in that. And we believe that as we move forward, you could start to see this consolidation happen, and you'll have more confidence in the direction. I was talking to the portfolio manager, Josh Welcher, who we affectionately called Rocket, and we were talking about it essentially looking at it as a boxing match. You have no idea how long the match is going to last, how many rounds it's going to be, but one day either the Bulls or the Bears are going to win, and that energy will wane off, but it's really not waning in the marketplace, it's building. So when it happens, you will have an explosive direction that it's going to come out of. Now, it could either be on the northbound side, and you could see the market extend the gains that you've already had. Now, it also could be on the southbound side. So people are asking again, the most important thing to watch is how long that this transpires and what kind of energy build that you could have. Now, typically the energy is the depth of the trading range that you've been in. And if we equate it to 400 points, if you break down through the lower side of this, it's easily to extrapolate that the Nasdaq could go down to, let's say, 3,100. You can see the black dotted line below. Now, that's the last support level, the last major support level on a technical basis that you saw on the Nasdaq. It would be a very deep correction. You would be looking at somewhere in the vicinity. It could be close to that 20% mark that a lot of people could be anticipating at the beginning of the year. We actually put out, I said I would not be surprised of a 20 to a 30% correction in this market given the current situation and when the Fed stops the tapering and pushing money into the system. Now, the adverse could also happen if this wanes off and this volatility ends and the channel goes a little bit further. Going out into July, you could have the adverse where it could pop out the top. Now, this would require quite a few things. It could require, again, a stronger GDP. You would have to see a lot more consumer confidence, and believe it or not, you would have to see the velocity of money start to pick up for this market to continue on the trend that it is. If the Fed is not feeding the system, somebody has to feed the system. So again, trying to keep this short. I know that Josh says that we'll stay on towards the end, and I'll be here. So if there's any questions, I'll be more than happy to wrap that up. But a lot of what I've shown you today, other than the Nasdaq and the comments in regards to the behavioral aspect of the market, also with the fundamental and the technical side, are put into the quarterly report. So please read it. It's not that long. And I think it'll provide a lot of good information into the direction that we're in.
And Kev, real quick, before you go, if you could actually explain, I think there's a few people in here that may not have read the Velocity of Money report. If you could maybe put in just a quick summation, kind of what you're talking about when you talk about money and the velocity.
Sure. Yeah, that's actually a good point, right? So I'm making the assumption that people read our last report. So the velocity of money is the speed at which M2 is being used, and M2 is anything that can equate to liquidity in the market. So it could be anything from your checking account, cash, savings, anything that you can get to in a very relatively short period of time. And velocity accentuates how many times that dollar is being used. And so if I spend it at the grocer, and the grocer pays the farmer, and the farmer pays the guy who buys the seed, and the seed guy pays his worker, that's 4 times that same dollar has been used. So you can actually track, and the Fed tracks the velocity of money. What's very interesting, and you can pull this report, if you look it up on Google and just type in FRED, that's the Fred website, I use it all the time. And you go in, and when you land there and you type in Fred's search and you type in velocity of M2, you'll come up with this chart that I'm talking about. I don't have it, obviously, to put up in the webinar today. But the velocity of money, since it's been tracked, which is 1959, actually I think it's 56, 1956, is the lowest rate that it has ever been, which means that there is so much money out in the system that's not being used. And again, partly due to the taper, quantitative easing. I shouldn't say the taper. Taper means we're ending it. So quantitative easing plus non-confidence of the businesses as well as the individuals out there. Because of the housing debacle, because of what's transpired in the market over the last 15 years, the velocity of the money has shrunk into a level never been measured before. So again, you can track how fast money is being used into the system, and typically during an expansion period you want to see that velocity of money expand. Otherwise you could get an inclination that that expansion period could end. So even so, during this period, ever since 2000, now obviously the velocity of money in 1999 was very, very, very fast because of the technologies, well, which actually led to the technology bubble. But now you're getting the pendulum swing in the other direction, where we've never seen this low of velocity before.
Right, and I think that's, some of the big challenges, at least I know from when I've been out on the road talking to a lot of advisors, and Harold had mentioned this to me too, our national sales director, who's been out there talking to a lot of these guys, is the concerns of all of the quantitative easing just sitting on banks' balance sheets and corporate balance sheets. It hasn't actually come back into the economy and been productive like it needs to be, which I think goes into the uncertainty that a lot of people are feeling right now in the marketplace, and not really knowing exactly where this thing is going to go, which obviously can get tied into the volatility that you're talking about there, Kev, and the uncertainty in that boxing match between the bulls and the bears. And I think one of the things that obviously, and Rocket and Kev say this all the time, but markets hate uncertainty more than anything else. If they have bad news, they can go down, they know how to price that in. If they have good news, they can go up, they know how to price that in. But what they don't like is uncertainty, because they don't know what to do with it. And I get the feeling that there's a lot of people out there that have that basic feeling that this is where we're at. It's very uncertain. And I want to go in and talk about some of the ideas that we've heard from other advisors out there, and some of the things that people are using to help alleviate some of this uncertainty with their clients. And before I get into that, I just want to give a brief explanation of what we do and why it's a little bit different, because I see some new faces in here. But our foundation is that risk is nonlinear, and we believe that there's actually 4 phases. You heard Kevin mention them earlier, there's a bull phase, a bull neutral phase, a bear phase, and then you get into a bear neutral phase. And we have designed an algorithm that comes in and helps us with this tactical approach. And that tactical approach starts from this top-down kind of 100-year market theory where we've actually quantified the different phases that the market can be in, and we use fundamental analysis, technical analysis, and behavioral financial analysis to quantify these types of things. And then we come in from the bottom up with our cyclical trend indicator that is basically our algorithm that identifies the risk level on the cyclical or 1 to 5 year trend in the market, which clearly is where most people invest. I don't know many people out there that would invest in these 16-year channels or 18-year channels when they sit down and do their asset allocation. Most investors are concerned with the cyclical trend or the business cycle. And just real easily and clearly how we depict this is you can see you go into a bull phase, which shifts into a neutral phase and into a bear phase. And through all of these different phases, obviously over here would be your bear neutral phase, the risk level is completely different. And being able to identify that risk, I think, allows, again, advisors and their clients to have relative certainty of what's going on so they can sidestep some of those potential drawdowns.
Josh, let me jump in on that real quick because there's a point in the quarterly that is drawn out, and I think it's important to explain when you're sitting right here. If you look at from the beginning of the year till now, and you look at volatility and you look at the return that you are attempting to get, the alpha that you're looking to generate based on the volatility, a lot of people look at the Sharpe ratio. One thing that we do is we actually look at it a little differently, even though we do use the Sharpe. We look at it and say, okay, what range has it traded in, and what is the return at that expected at the end of that range? And if you just look at the first quarter, the return in the market was 1.8% on the S&P 500. Now, given that the last day was half of that, or 0.78% was on the last day, but it also vacillated in a range of 7.6%. So you're looking at 23.5% return for the risk that you received in the first quarter, and that's not very good. Now, we also know you can't look at that just in the first quarter period of time, but it's important to understand that when you get into a situation where you're getting not only less than half, but less than a quarter of the percent, and that could have been an eighth if you didn't have the last day of the quarter, you start running into a situation where, okay, is the volatility too much for the return that I could anticipate getting out of this? And this is one of the points that Josh is making during those neutral zones that you see on the screen. You'll see the blue area and the yellow areas, is to point it out, even if you look at a bull cycle or a bear cycle, you're still going to get volatility, but you're getting paid for the volatility that you're accepting. And what's important about the way we look at the world is that if it gets to a point where you're not getting paid for the volatility, it throws up a red flag and a warning sign.
Right. Yeah, that's a good point. Thanks for that, Kev. And I think that's kind of where we're beginning to get in. At least a lot of the advisors, again, that Harold and I are talking with are sharing these concerns. And again, just real quickly before we move into our portfolios and start talking about some tactics that people are using to circumvent some of this volatility and really prepare for either direction, the winding of that spring, whichever way it's going to unload. We have, this is our cyclical trend index, is what I tell you. It basically identifies the risk parameters within the market. And what we've done here is just put it on the S&P 500 back to its inception in 1963. This is a quantitative, rules-based tactical index. It's an indicator that allows us to understand where the risk is. So very simply, where it's green, the risk would be low, and where it's red, the risk would be high. And this really is kind of the foundation that drives all of our portfolios, and they have some things that move around this. I also want to point out one more thing before we get into it, and that is we're a tactical money manager. And I think tactical is a little bit overused and misused sometimes in the industry. We're a quantitative tactical money manager. So we quantify our process and we quantify our model. There's some people out there that are not a quantitative tactical manager, which can bring in some subjectivity, and you're starting to see some of that in the industry. And I want to point that out in the fact that everything that we do is completely rules-based. Our process is quantified, as well as the engine that drives it is quantified. So what we'll do now is kind of jump into some of these portfolios and talk to you guys about some of the things that people out there are doing. As you guys know, we have 3 portfolios. We have a conservative growth portfolio that we're looking at here. We have a long-short tactical portfolio, and then we have a strategic income portfolio that is really, I think, primed, and I think where the market's at now, and I know Rocket's been saying this for a long time, it's a great time to be looking into that. Everybody's looking for yield, so we'll finish up with it. But Sages you can see the current volatility in it is about 42% less than the S&P 500. And again, this is a conservative growth portfolio, so you can see we're lagging the market here a little bit. But if you look at it over a larger cycle, and last year we did what this portfolio is supposed to do. We are going to eliminate some of that volatility, and we're also going to grab some of that alpha. But in these neutral phases, these bull and bear neutral phases, it's going to be more designed to eliminate that volatility and really button up those hatches and have a little bit less exposure, so that you're not getting whipsawed all over the place. And a lot of advisors that we're talking to are looking at putting this in as a core, because one of the unique things about this portfolio is it actually has the ability to hedge. So if we did get that 20 or 30% drop from that spring winding up, we will have the ability in this portfolio to bring in and bring it down to a zero exposure in the marketplace to protect that principal. And then obviously, as the market bottoms out based on our CTI, we'll then redeploy that capital into some of those high growth phases in the market. And we do have a little ability to mask it on the short side if we have extreme confidence, but it's really not the point of the portfolio. So some of these guys are looking at this as kind of a core portfolio in it. And when we get through this towards the end, we'll talk about, we'll open this thing up to Q&A, but it's very, very briefly, based on the fact that we believe risk is nonlinear, what Sage will do is obviously it's allocating these high growth areas down here. As we come up into these neutral phases, it begins to shift over into some more defensive sectors and industry groups. I may have forgot to mention it's a sector rotation strategy. So by the time we get over here, if that does happen into the bear phase, we're going to be completely allocated into these defensive sectors and industry groups. And if the market does just completely fall apart, obviously we have the ability with an inverse ETF to come in and button that thing up, protect that capital. And then down here, of course, in these bull neutral phases, we'll look to redeploy that capital and begin to roll into getting long the market. I think our current exposure, and Rocket, you have to correct me if I'm wrong, I think it was on there. Right now we're about 40% exposure in Sage, as you guys can see down here. That's where we're at. So kind of onto our long-short pulse. This is our long-short ETF strategy. And this is a really unique strategy. Obviously,